Today, Indian investors are building larger portfolios, and naturally, they want to look beyond the domestic market to diversify globally. For years, the default move was simple. You just bought a domestic international mutual fund and let the managers handle the rest. But that system hit a hard limit. The industry reached a strict $7 billion overseas investment cap, freezing new inflows and leaving investors stuck. To bypass that freeze, two highly distinct alternatives have emerged: funds based in Gift City and direct U.S. brokerages. Gift City, Gujarat International Finance Tech City, was built specifically to serve as India's specialized international financial hub. Because it operates under its own regulatory framework overseen by the IFSCA, it is completely immune to that $7 billion domestic mutual fund limit. On the other side, the direct U.S. route lets you use the liberalized remittance scheme to wire money straight to regulated American brokerages apps. Both options get your money into global markets, but they run on entirely different cost structures, tax rules, and risk profiles. The choice you make depends heavily on your specific capital reality. This scale shows the first thing to know about the Gift City route. It has a massive financial barrier to entry. For most of these funds, you need a minimum initial investment of $75,000, or roughly 65 lakh rupees. While a few retail options exist starting around $5,000, this ecosystem is primarily built for high net worth capital. If you clear that hurdle, you get the convenience of professional active management. Experts handle the research and select the high-growth global stocks for you. That convenience comes at a premium, usually costing between 1.5 and 2.5% in annual expense ratios. The Gift City structure provides a critical advantage beyond simple management. It acts as a legal buffer against American tax laws. Holding over $60,000 triggers a severe 40% U.S. estate tax penalty. Gift City structures create a legal buffer that completely protects your portfolio from this hit. Additionally, cash inside the fund avoids the 180-day repatriation requirement, allowing your money to compound seamlessly. So, Gift City operates as a premium walled garden. You accept higher fees and forfeit control over specific stock picks, but you secure maximum legal convenience and tax protection. For a hands-on approach, the direct U.S. route lets you bypass those domestic gatekeepers entirely. Through modern brokerages, you can use fractional investing to buy micro-slices of highly expensive stocks, meaning you don't need a massive portfolio to get started. With just a few dollars, you can take direct ownership in mega-cap tech companies like Tesla. In fact, this ecosystem grants you granular access to over 6,000 individual equities, including major index ETFs and single stocks like Amazon. Buying these assets directly eliminates those 1 to 2.5% recurring management fees completely, and your account holds a built-in safety net. Regulated U.S. brokers are backed by SIPC insurance, protecting your assets up to $500,000 if the platform itself fails. However, this total control comes with hidden administrative traps. Under the liberalized remittance scheme, cash from selling stock must be reinvested or wired to India within exactly 180 days. Additionally, if direct holdings cross $60,000, a 40% U.S. estate tax becomes a severe liability for your heirs. Direct investing gives you unmatched flexibility and zero management fees, but you have to shoulder the full burden of stock research, tight compliance timelines, and serious estate tax risks. This decision flow chart maps out the correct structure for you based on two specific variables: your capital size and your management appetite. The first filter is simple. Do you have more than $75,000 to deploy right now? If the answer is no, direct U.S. investing is your primary viable path. If you do clear that capital threshold, you face a second question. Do you demand the ability to pick specific individual stocks? If you require a hands-on approach and want to build a highly customized portfolio, you still need the direct U.S. route. But if you have high capital, want hands-off compounding, and demand absolute protection from that 40% U.S. estate tax, the Gift City route is built exactly for you. In a market restricted by that $7 billion cap, buying foreign equities means the legal plumbing you choose is just as critical as the global assets you buy.
रिस्क सिर्फ मार्केट में होता है, प्लानिंग में नहीं। DGN कैपिटल मैनेजमेंट के साथ स्टॉक मार्केट, म्यूचुअल फंड और इंश्योरेंस AMFI IRDAI certified. Your success our priority.